Good day, everyone. My name is Rebecca Lilly with the International Association for Energy Economics. It gives me great pleasure to welcome you today to today's webinar entitled The Economic Growth Modeling We Need, Insights from the Harmony Growth Model. We are grateful to our speaker, Dr. Carrie King from the University of Texas at Austin, for today's timely discussion. First, a little bit about the International Association for Energy Economics. We are the largest association specializing in the field of energy economics and provide a forum for the exchange of ideas, experience, and issues among professionals interested in the field. The organization produces 2 professional journals, a newsletter, and holds conferences and virtual presentations, along with a host of other products and services that you can find at our website at www.iaee.org. If you're not already a member of the association, we welcome you to join. A few housekeeping matters in regard to today's webinar before I hand things over to our speaker. First, this webinar is being recorded for those that cannot participate in today's live event. If you have questions for the speaker, please click the Q&A button at the bottom of the Zoom window and type your question. We have allocated sufficient time at the end of the webinar to address your questions. And now, I would like to introduce you to our speaker, Dr. Carrie King, research scientist and assistant director of the Energy Institute at the University of Texas at Austin. Carrie, over to you.
Okay, thank you very much, Rebecca. Thanks all of you for joining this morning. So morning in the US, North America, and afternoon in Europe. So today I'm going to discuss a recent paper of mine that's on my economic growth model that I call HARMONEY. So I'll briefly discuss that. And this is in some sense, yes, I think the economic growth modeling we need in terms of its structure and its ability to simulate economic dynamics. So yes, today I'm discussing this paper. It's recently published in Biophysical Economics and Sustainability. You can email me, or this will be on the last slide as well. If you need to look up the paper, it's open access and free online. So the kind of motivations for my research here on macroeconomic modeling are to demonstrate what I think is a more accurate framework, let's just say as opposed to, or as in contrast to, neoclassical equilibrium approaches for studying long-term energy and economic dynamics, and understanding the relationships between resource consumption in general, energy consumption in specifically, and economic other dynamics. The approach uses what is known as a stock and flow consistent framework of money, which is common in post-Keynesian analysis. And we might also call this a biophysical or ecological economic model in the sense that it tracks biophysical states like mass and energy. So we're tracking mass and energy flow consistently with the tracking of money flow. The goal here, at least in my kind of long-term research goals, are to explain if and how the finite Earth affects various economic trends. So if we're observing economic trends in the real world, how much can we attribute these to ideas of depletion or essentially finite Earth type effects? This can be viewed as investment, wages, debt, unemployment, all kinds of different factors or structural factors of the economy. And ultimately, if you can use this framework to sort of mimic historical trends or long-term historical trends, if we think very, very grandly, we might think about agrarian to fossil industrial economy type transition. If we have confidence in that, then perhaps we have more confidence to think about modeling a fossil energy transition to a renewable or low carbon economy using modern equipment. And feel free to ask questions, I should have said, in the Q&A during the presentation, and I have those up, so I'll attempt to answer those as they come up if they're kind of clarifying questions. So I'll give a brief description of this Harmony growth model, which is short for Human and Resources with Money model. The title is kind of taken from some papers, or at least based on papers that I used in my original paper when I first made the model. So the paper I'm discussing today is the second paper on this model. So we might think of, I guess, biophysical models of tracking population, natural resources, capital as a physical concept. So, trying to understand, some sort of societal operations, maybe a predator-prey type model of a population and depending upon a natural resource base. And we might think about economic models or macroeconomic growth models that, again, might consider population capital usually as a monetary concept, not as a physical concept. Often wages, employment, debt sometimes. So this is not so common in some orthodox economic approaches, but I'm including it here as this post-Keynesian type approach. And so when I made these models, I was attempting to essentially combine the simplest version of both of these types of models into one in a consistent framework. So that's what the Harmony model at this point is. It's still a toy model, but I'm working on calibrating it to real world economies now. So here I'll just outline kind of the flow structure of the model. So there is a natural resource, nature, I just say in this case, like a forest. And in the model, I'll show you it indeed is like a forest in the sense that it regenerates. So it's the natural resource is only one, and it's akin to a forest. Essentially, economic activity, the resource is extracted in order to essentially power economic activity, and there are four flows of natural resources in the model. One flow that gets distributed or allocated to, which is nature to extract, nature to operate capital, whose job it is to extract resources itself. So this is like the energy sector, if you will. So there's a type of capital, it's called the extraction capital, and its job is to operate this capital to extract resources themselves. The model is essentially a two economic sector model. The other sector is called the goods sector, and its job is to make more capital. And so there is some nature that is used to operate machines whose job it is to make more machines. A third, so the goods capital produces goods that any leftover goods, which are essentially investment goods or capital goods, anything left over is left for consumption by households. So those are the two sectors. That's all it is in this model in terms of intermediate sectors that have production. A third resource flow goes to human consumption. So there is essentially, labor, workers, population, and they require resource consumption to maintain livelihoods, to reduce death rates. So if there's not enough consumption, death rates will increase. If there is enough human consumption left over, or resource consumption left over for households, then death rates will be low, the population will increase. So this is how population is regulated. And the fourth one here, which is the second one from the bottom, is the nature embodied in capital. That is to say, if you make an investment decision based upon monetary criteria, in order to make a capital good as a physical item, it has to be composed of nature itself. So this is nature embodied in capital. And there's an investment decision that's based upon monetary outcomes or profits, essentially, that I'll summarize in a slide in a second. These investment decisions are made separately for both capital goods for the goods sector and for the extraction sector. So they're each independently deciding how much new capital they want to invest in. But again, all that capital is made by the goods sector itself. So this is kind of the structural flow. It has these units. So the units on the left and the sort of green arrows are units of natural resource flows. The blue arrows in the middle are units of goods flows, are capital. And then the units on the right and the red arrows are units of money. So these are all sort of consistently integrated. So the highlights of the model framework, which I won't go into much. What is the depreciation of capital in this model? I see that question. It's just a constant rate of depreciation that applied equally to both sectors. So, or a constant fraction of existing capital. So it's a post-Keynesian, what we call a post-Keynesian structure that uses, again, what we call the stock and flow consistent macroeconomic accounting of money. And also there are private banks. So private banks create money by issuing loans as debt to firms. So if a firm, one of the sectors wants to invest more money than it is making in profits, it essentially takes out a loan and pays interest at some constant rate based upon its debt. Natural resources are tracked via conservation of flows. So just we have conservation of money flowing that we have to track as an accounting identity. There's conservation of physical flows of mass and energy. So natural resource extraction consumes more resources, the more the resource is depleted. So this is a natural feedback in the model. It essentially says if you're, extracting a forest or digging up a mineral, the deeper you dig or the further into the forest you extract, the more it takes to bring it back to your production system, if you will. So the more that it gets extracted, the more it is to extract the next bit of resource. Each one of the following are required for production and can limit output. So you need a capital as machines, and I'm tracking capacity utilization of this capital. You need labor to operate the machine, and you need natural resource consumption as fuel, or to become embodied in making a new machine. So any one of these, so this is effectively a Leontief type production function where any one of these three can limit the output. There are wages that people get paid to work in these sectors. In the short run, it's based upon a Phillips curve idea where if employment or participation rate is above some nominal value, and the charts I'll show, it'll be 60%, then the short run wages will look to short run. The wages will increase based upon employment. And the long run wages will increase with average inflation, or they have the option to increase with average inflation. I see the question on the solo growth model, so maybe, I don't know if I'll be able to allow you to ask it in person later. Maybe I'll hold that to the end. And investment is a function of profits, which is say more profits, more investment, but you can also take out a loan as well. So investment does essentially exceed profits and accumulates debt for the companies that then they pay it off. So solving for prices are essentially a markup on the cost of production. This is kind of maybe first order level post-Keynesian structure. And I'll show results assuming a constant markup fraction, this mu, in this presentation. So solving for prices, I have a full cost and a marginal cost of production, and I compare results using both of these. So in this sense, the costs are depreciation, which is this constant depreciation rate times the price of capital, so the value of capital, price of goods times capital. Interest payments on debt. So I think perhaps this is different than solo growth model. So R is a constant interest rate in this particular case, and debt, D is the debt level. And it's also a cost of wages times labor, so total cost of wages per person. And there's intermediate purchases of goods and extracted resources. So this has the intermediate sectors here, which I won't go into, but again, there's a feedback here on that limits growth is essentially based upon the resource quality and the necessity to consume more resources to extract the marginal resource as you deplete. So that's the full cost of production. And then there's the marginal cost of production, which essentially neglects passing on interest payments and depreciations if those cannot be passed on to pricing. So I'll just show some results that compare and contrast these just to give slightly different perspectives on what might be occurring. Here's the wages as a function of employment. So this is the rate of change of wages. So this F lambda is the short run Phillips curve, just in a cartoon diagram on the right. So there's some nominal employment that crosses the x-axis, of which employment would be at some nominal targeted value, but could fluctuate around that in the short term. But by choosing W1 and W2, these inflation factors, you can have wages increase or not increase with inflation, and I'll play with some results on that as well. So I'll now show some results from this paper. And again, it's not calibrated to the real world. It's essentially a toy model still at this point. So the important feedbacks are to understand the dynamics, or the trends in the dynamics. So keep in mind the causal effects. Assuming the model, there's sectors invest into capital. Essentially, they have a behavior or decision function to invest into capital. Then calculate how much labor is needed, what the employment level is, and therefore what the wages are. Determine if any of these are limiting output. And then calculate both the gross output, the total output flow in a physical sense, and the net output as well. And then in this model, household consumption is, as we might say, fully accommodative. So consumption is essentially whatever is left over from the accounting identity of net output minus investment and the change in value of inventory. So there's no independent consumption behavior in this model. All right, so I vary two things to compare the results. One is the definition of cost, which full versus marginal cost, which I discussed. The second is a change in efficiency, or at least the amount of fuel, if you will, or resource required to operate capital. So this is just an exogenous increase that I pose in the model to explore the effects of making that change. And so the model grows from an equilibrium economy, so having zero growth, essentially a steady state population, level of capital, et cetera. And so the results I'll show are starting from that situation. And the resource extraction is a multiplication of these four factors here. Delta Y is a parameter, the technological parameter. Y is the quantity of resources at any given point, and then K is the capital for extraction, and CU is the capacity utilization. So for a small economy, the extraction parameter delta Y is a low number, and essentially it doesn't have a lot of technological capability. A higher number there means higher technological capability in some sense. And so a growing economy, I just increase this delta Y parameter so that it can more effectively or more profitably extract the resource and grow the economy. So that's essentially what you'll be looking at when you see the results. Okay, so here I'm just going to highlight what one result kind of looks like here. So here is available natural resources. So it starts, the maximum resource size is 100 in this case. It starts at some equilibrium on the left, and then I increase this delta Y parameter, and the resource increases to the right, or the simulation proceeds to the right. So in each chart I'm going to show, there's two solid lines. So there's a black solid line, which is the full cost model, as if there's no enhanced efficiency of fuel efficiency of capital. And then the gray line is if there is an enhanced efficiency effect of capital. So that's the black line to the gray line. And then the solid lines are when there's the full cost assumption, and the dashed lines are when there's the marginal cost assumption. So they give slightly different types of dynamics. The marginal cost, a little bit of an overshoot effect, and then the full cost with sort of a bit less, at least given the rest of the parameters of the model, essentially with a lack of an overshoot particular case here. So there's available natural resources. It extracts the resource gets depleted and ends up eventually at a steady state. Track capital accumulation. In this case, it's both types added together. Again, efficiency. I'll be highlighting the effects of efficiency here in the next couple of slides, so I won't go into that here. Population change. So these are the kind of standard things we can look at. Population not being regulated again by the resource base that is left over. So as the economy grows, more of the resource base has to get allocated to maintaining the existing capital and operating the existing capital, and so that less resources are available for the population. And eventually there's the resource per person in the population reaches the level that birth rates equal death rates. Here's some other parameters: resource extraction rate. So this would be essentially the equivalent of primary energy extraction, although it plays the role of both energy and mass. On the left, net output, both sectors added together. Participation rate on the right sort of maintains its nominal level around 60%, but fluctuates as the economy goes through its growth cycle. And here's a factor that sort of we biophysical economists pay attention to a bit. I'm calling this the net external power ratio. There are people in the literature might call this the energy return on energy investment. It's essentially how much energy is available from the energy extraction sector or from the energy sector for the rest of the economy. So a bigger number means the energy sector is not consuming very much energy that it extracts, and a low number means the energy sector is consuming a high amount of the energy that it extracts. So this is, in some sense, a measure of the productivity of the resource base and the technological level. Wage shares, profit shares, debt ratios. So we can see on the right, debt ratios are going up during the extraction rate, the growth cycle, but then once extraction rates level out effectively, the debt is paid back and goes back to zero. So I'm going to highlight these trends later, so I'll skip those now. All right, so I'm going to highlight a few insights that I think come from this model. Some of them are not particularly unique to this model, but one is the idea of the Jevons paradox, or that efficiency begets more consumption and accumulation rather than less, at least over time. So here's the available natural resource base. This is the chart I showed before. So again, going from the black line to the gray line is more efficiency. And it's the solid lines is for the full cost case, and the dashed lines is for this marginal cost case. But again, from black to gray is increase in efficiency. So the increase in efficiency of operating capital, the fuel operating efficiency, allows higher resource depletion, essentially, lower costs to go to operate the economy, which allows more investment to go to the extraction sector itself. So, and the extraction capital effectively becomes more fuel efficient. So I'm going to highlight some other trends that are also going on at the same time. So that's the one we just looked at. So in the upper right here, then we'll see the resource extraction rate. So the increase in efficiency allows a higher resource extraction rate. So in the real world, we'd observe that we have more efficient machines, essentially over time, over the last 200 years, in terms of fossil fuel-based machines or fuel-based machines and steam engines and steam cycles. And we have indeed extracted more resources. So this is in some sense consistent with that idea. The population has gone up as well. So if you have less resources that are required to operate the machines that you have, then there could be more resources allocated for the accumulation of stocks in the model, and population is one of those. So we can accumulate a higher population, and capital. So we looked at that earlier. So increase in efficiency allows the higher accumulation of capital in machines. So if you have less resources being used to operate machines, then there's more resource flow available to become embodied in making new machines, and then maintaining those new machines as well at a constant rate. So this is the short explanation of this, and I'm going to look at some growth rates later that sort of give another idea of how to perceive the changes in efficiency and the changes in cost in terms of decoupling and the ideas of relative decoupling and energy efficiency as well. So insight number 2, economy shows the same energy size scaling as a biological growth. So I've been looking at biological growth literature, and I mentioned some of this in my book that came out a couple of years ago, the economic superorganism. But the idea is that the economy exhibits some similar patterns. The data exhibit some similar patterns as to the growth of biological systems. In this case, a mammal or an animal posed here on the left. So this is just this is not data. This is just from a model from a paper, the West, Brown and Inquist model 2001, that describes biological growth. One of the takeaways from the biological growth literature is that the metabolism, which is basal metabolism, which they refer to usually as B, scales with the mass of the organism to the 3/4 power. So a 10 times bigger mass animal does not consume 10 times more energy to just kind of maintain its resting state. It consumes something like 10 to the 3/4 power more energy, or something like, I think that's about 5.6 times more. And so that's what's kind of shown here on the left in this scaling relationship of metabolic power to body mass for the 0.75 relation, which is the basal metabolic power, the black line in the middle. The bottom line is how much metabolism is used to grow. So if you're a growing animal, then some of the energy you use is to accumulate more mass. And due to how the scaling works, or at least it's supposed to work, the total metabolic power would scale something like the 0.5 power of the mass. And so we have these 3 parts. How much power do you need to maintain what you have, which is what the basal metabolic power is? How much power do you need to grow, which is what the gray line is? And then you add the 2 together and you get the total metabolic power in relation to mass. And they come together at the end to a single point with the idea that animals, most mammals, tend to grow to a certain size and then stop growing at that point. So in the harmony model, I can plot the same basic thing, natural resource extraction on the y-axis on the right, and then capital is a physical notion on the x-axis. So this isn't the value of capital, although it turns out the price of goods, the price of capital doesn't change largely in the model. So it looks pretty similar. But at least in the model, I can track something that's akin to mass. And it sort of goes up and grows and has this declining returns as well. So the full cost model rises to an equilibrium size and stops, kind of like animals, and which is the solid lines here. The black line is right behind the gray line, so it's hard to see independently. And then the marginal cost model reaches a larger size, but it kind of overshoots and kind of loops back down. So that looks a little bit different. So this, would, lead me to think or hypothesize that essentially the full, animals have to have a full cost model. Essentially, they're not having only charging marginal costs of depreciation. They don't have a debt idea with their mass, but maybe they have to sort of inherently incorporate depreciation costs of their cells and regenerate their cells, and they can't not pass on that cost to themselves. So on the chart on the right is which I basically mimicking the chart on the left from the biological literature, and on the right it's from my model. So again, the simulation starts from a steady state, which would be zero resource consumption for net growth. So that's why it starts at 0, as opposed to a non-zero number, which is on the left is like a cow being born. So it starts from there. And then we have the total resource extraction on the dashed line, which is essentially the basal resource consumption, the consumption required just to maintain the existing capital base, including its depreciation, and then the resource consumption for net growth. So if we add the net growth resource consumption to the basal, we get total resource extraction. And I'm posing these have essentially similar looking patterns. And in some, I would say this is maybe not too unexpected. In some sense, we should expect this. The model is structured, the Harmony model is structured in a way that it can mimic this kind of approach. So this is a way to try to link across disciplines and understand ecology and biology in the context of the economy, or vice versa, rather. So insight number 3, let's say enhanced interpretation of decoupling resource consumption from GDP. So this is a big discussion, obviously. Does efficiency reduce energy consumption overall? And this is seen as a big policy lever for reducing greenhouse gas emissions, which is to say, if you can reduce greenhouse gas emissions from becoming more efficient, then that should be one of the things you invest in for a low carbon economy. And of course, there's discussion of whether that actually happens. I'm not someone who believes that the literature shows that that is actually what happens. So on the left here is global data. So this is real world data. This is not from the model. Each dot here is a data point from the year 1900 to 2018. And so what it's showing is the growth rate of primary energy on the y-axis, and the growth rate of global gross domestic product or gross world product on the x-axis. So a 2%, a value of 2 on the y-axis or x-axis means that that quantity is growing at 2% per year. And 0, 0 is kind of here in the slightly lower left. So each dot is a data of the rate of change from one year to the next annually. And then I have a very admittedly crude averaging concept. It's just averaging 12 years at a time to show this general pattern in the dark black lines with the squares. And what it shows is that from around the early 1900s until beginning of the 1970s, the global economy existed on this 1-to-1 ratio, which is to say, as gross world product went up 1%, primary energy went up about 1% as well. But after the 1970s, it ends up along this 2-to-3 ratio line, which is to say, global primary energy grew at about 2% a year on average, and gross world product grew at about 3% per year on average. And so this would be the area of relative decoupling or declining energy intensity, right? Energy consumption's increasing more slowly than GDP. And so there was this change between these two regimes over the last 120 years. And on the right is the same plot for the model, for my Harmony model, and the same results we've been looking at. So they're a little crowded on here, but in general, I'm just going to try to highlight a couple of the points and go through it here. One is, if you're in this triangle area, this would be the area that's called relative decoupling, or essentially declining energy intensity, that people view as akin to energy efficiency, but it's specifically not, at least in terms of the data, it's not energy efficiency. It is energy divided by GDP. It doesn't have thermodynamic units of energy efficiency. And they both the model and the data kind of have this clockwise rotation. As you're growing, it kind of goes up along near this 1-to-1 ratio or slightly above. And then there is a decline in growth rates. And when there's decline in growth rates, it comes back down into the left, sort of does this clockwise rotation. So the economy used to be growing at about 4% a year in the 60s and 70s. And then now it's only about 3% a year. So it didn't come straight down. It didn't go down to the right. Basically, I'm saying it came down into the left is what the data show. And my model shows the kind of the same approach. And it does this essentially when you can no longer grow as rapidly as you used to be able to grow due to resource constraints, specifically in my model, then there essentially is no choice but for the model to come sort of down into the left on this chart, which is to say reduce growth rates. And when it does, it doesn't reduce the growth rate of resource extraction at the same as GDP. Resource extraction declines more quickly than GDP. So this is the concept of relative decoupling, right? That the growth rate of resource extraction is less than the growth rate of GDP. So I'm going to just highlight in the model what is kind of being described here. So this, again, is the blue triangular area. I'm going to highlight the difference between the simulations here just to make it explicit what's due to efficiency changes and what's due to other kind of just structural necessities of the model. So the first thing I'll highlight here is that, again, when you go from the black line, solid line to the black dashed line, the only difference in the model is using full cost for the solid line and using a marginal cost assumption to form prices in the dashed line. So anytime you go from a solid to a dashed line, it's a marginal cost assumption. So the thought here is that marginal costs essentially give the impression that the economy is more relatively decoupled than it otherwise is. It also accumulates more debt. Not going back to that chart, but that's the other highlight, is that the debt ratio of the economy grows higher under the marginal cost assumption. So maybe that makes us perceive that the economy is more decoupled if we accumulate more debt. And the second thing I'll highlight here is that actually increasing resource consumption efficiency of capital, which is what declining energy intensity is often attributed to, also gives the perception of relative decoupling. So that's not completely, that's not completely false, right? Energy efficiency in this case mostly occurs at the beginning parts of the simulation and is relatively constant in the latter half of the simulation. But nonetheless, more efficient capital does later give evidence, or at least produces economic trends that are more heavily relatively decoupled. So they're both in play. And so my takeaway from here is that it's not just one or the other. There are many things that could cause the economy to appear as though it's relatively decoupled, but in no cases is actually consuming less resources, as we've seen from previous charts. Okay. Insight number 4. So the labor and wage share versus capital or capital share and resource consumption trade-off, right? So this trade-off between potentially profits and wages, and then how this relates to resource consumption rates. So in the model here on the left, there's the wage share. There's no government in the model, so the wage share is kind of particularly high because there's no government taxation. And the black lines in the solid gray line are when workers have quote unquote full bargaining power. So they have the ability, that means that wages increase with inflation. And so if wages increase with inflation, then the wage share increases after the growth cycle is kind of coming to an end. The wage share goes down a little bit as the growth cycle is increasing. And then once resource consumption peaks, debt goes down to zero, profits go to zero, and therefore the wages come back up. So that's shown over here with the profits. So this is the profits of both the sectors added together. And so this is kind of this direct trade-off here. Profits go down, wages go up. Profits go up, wages go down a little bit. So they're kind of a one-to-one kind of relationship here. And this is the full cost model, by the way, that I'm showing you. All these are the two solid lines. And if workers' wages no longer increase with inflation, which is to say, we take away the wage bargaining power, if you will, in the middle of the simulation here, such that wages, if inflation goes up, wages stay stagnant in a nominal sense. Wages decline in the full cost model, which is the black dashed line, and they decline to zero eventually. In the gray dashed line, in the marginal cost case, wages decline again, but they don't rise back up as they did when they have full bargaining power. They stay essentially relatively constant. And so this is equivalent to tracking the profit share here on the right. So the profits have been maintained. That when you lose bargaining power, the profits go up for the extractive industries or the good sectors as well added together. The profits for the marginal cost case, which is the gray dashed line, when you lose bargaining power, go down. But part of the reason why the wage share stays high is because the debt ratio stays high and interest payments take up the other part of the income share of the economy. So this model has some demonstration of at least playing around with the idea of wage bargaining power, at least in an equation sense, and seeing how it affects things. So does this have something to say that's going on in the real world? Well, these are data that many of you have probably looked at in more detail than myself. This is just standard data as the percentage of GDP. Sorry for the x-axis is not, or y-axis on the left on this chart is not labeled, but this is the percentage of GDP going to wages, or the wage share of the US economy. When I've added a few of the dots of the last few years, which wage share has been going up the last few years. And then the red line is the energy consumption per person in the US economy from 1929. So we kind of have this flat period until the 1970s of wage share, and then it declines after that. And of course, this has been the idea of much discussion. So in my model, this is the full cost model and full wage bargaining power here. This is the data I've already shown you with the wage share on the top, but then I'm now showing you resource consumption per person of the model. So it doesn't exactly look the same there when you have full wage bargaining power. Resource consumption in the model peaks, then declines as the economy grows. But if you take away the wage bargaining power, sort of at time 60 to time 160, and say, hey, resource consumption is peaked per person, and we're now going to shift, we're not going to allow wages to increase with bargaining power, which some argue is effectively what started happening in the 1970s in the US, then you get this other pattern. And the idea here is maybe there's something here that's interesting to explore further. Essentially, a roughly constant wage share and then a declining wage share once wage bargaining power is lost, and that this coincides with the time at which resource consumption goes up, but then no longer per person, but then no longer increases as well. So we have a similar pattern of roughly flat and then down for wage share, coincident with increasing resource consumption per person and then roughly going flat afterwards, and that these turning points occur at roughly the same time. So, so this is something I see to explore further, and we'd love to have comments on this and how much this could be used to explain this phenomenon or not. Marginal cost still goes down, right? So here's the chart on the left. When you take away wage bargaining power in the marginal cost model, it doesn't continually go down forever. And that's, one might argue this is that the economy, global economy or the US economy is mostly based on marginal cost pricing, or at least not being able to pass off debt payments to customers. Depends on the industry. So it remains to be seen how much this occurs, but hopefully maybe there can be some insights into what we might expect for wage and profit trade-offs. Okay, so now I'll highlight one last thing here, which is looking at the structure of the economy, at least in some sense. So the evolution of economic structure and complexity, if we might want to use a more grand word than that. And to do this, I'm building off the 2016 paper in which I looked at US data. So I'm going to compare the model to US data just because it has an interesting, seems to have an interesting parallel. And here's just, kind of a standard input-output table framework. This is just to show you what I'm calculating. And I have a two-sector model, as I said. So there's two intermediate sectors. So there's money. So this is calculating the money flowing through each of these sectors to and from each other. So we can calculate how much money is flowing in the intermediate goods matrix or the transactions matrix, and we can divide it by the total. And so we get a fraction. So we say what fraction or what percentage is flowing in one sector between another sector, and what fraction is flowing in the others. So it's just 2x2 matrix for my simple toy model here. But these fractions are what I'm going to use to track the structure of the economy. That is to say, how are these fractions changing over time and what's their distribution? And to do that, I use information theory or information theoretic metrics, which I will summarize here on this slide. So information entropy essentially describes the distribution of a set of probabilities. And that's information entropy is the addition of y-axis here, conditional entropy and mutual constraint. So that's not so important to have to understand right now, but what you can get from this is that whenever you calculate these metrics within a matrix of numbers that sum to one, or matrix of fractions, you get some number inside this triangle. And so if you're at the upper end of this triangle, which you have maximum conditional entropy and 0 mutual constraint, this means that every number is exactly the same. So 1/4, 1/4, 1/4, and they all sum to 1. So that's what you are if you're at the top of this triangle. You have a uniform matrix. If you're at the far right of this triangle, you have a matrix where there's only one number in each row or column, and that number is the same. So a half and a half in this case. It could also be a diagonal matrix, half and half, and that would also be the same point in terms of the distribution of numbers. And if you're at the bottom left of this, you only have one number, non-zero number in the matrix, and everybody else is 0. So this is in some sense the least complex economy, and effectively it's not even a network. It doesn't even have sectors that are interacting with each other. There's just sort of one sector to sector interaction. So in the middle here is all the complexities. And so the idea is we can look at these metrics to see how these numbers are changing over time without having to actually look at them individually. And so here's the US data that I published in 2016. From 1947 is the first input-output table, and then 2012 at the time was the last one. That was kind of a benchmark use table of the United States economy. And they're roughly every 5 years. And so from here, we basically get this idea that, okay, if we look in this sort of triangle on the left, but I've zoomed in on it here on the right, but if we have this kind of triangle, the pattern of growth cycle, if you will, this is a structural trend of the United States economy, is to go in this kind of counterclockwise direction. This is essentially the data from the United States. And if we look at the data from my model, simulations from my model, the simulations that I've sort of showed you with these different marginal cost assumptions on this plot, is that I also get a sort of counterclockwise pattern. So I've highlighted or I've superimposed the US data in red onto this chart. So those are the dashed lines with the big red dots. And then the gray and black lines are from the model. And it's not obvious, I'm not showing here on the model, but they do go in a counterclockwise motion. They grow up and to the right first, they loop back around to the left and end up back at the same point for some of them, and end up at slightly different points for those that change efficiency. So the general point here is they both have this counterclockwise direction. And we can look at each particular metric by itself and see if they have similar trends, right? So again, my model is a toy model. It's not tuned to the United States. So the model time here there's nothing I'm imposing that says the model time should correspond to any particular times or years in the United States data. So I've made these charts so that it looks as though they do, right? So that's just trying not to confuse you there, that it magically matches up. I plotted this to essentially make them match up, but the scaling is the same on each one of these charts. So on the left is this information entropy metric, which is the combination of the two on the right. If you add the two on the right together, you get the one on the left. And from a general complexity standpoint, people would often think, yeah, if a self-organized complex system is growing, it will increase its information entropy and become, quote unquote, more complex. If you have higher information entropy, you're essentially more difficult to explain. It takes more information to explain what's going on in the system. You have more parts doing more things, et cetera. And so the United States goes up, stays relatively flat from 1967 to 1992 in information entropy, and then declines. And the model here has a similar looking trend. It grows, maybe that stays relatively flat for a while and then declines. The interesting thing is it's composed of the two parts, which also have similar patterns. So conditional entropy grows up. And again, if the center one, conditional entropy, if this is going up, it means all of the sector-to-sector transactions are becoming more equal. And if it's going down, it means you're no longer having equal, you're getting less equal sector-to-sector transactions. And the peak in 1997 for the United States is roughly looking at in 2002, which would be the dot right after it, is the time of cheapest energy effectively in terms of an intermediate sector transaction. So all energy spending in the intermediate transactions divided by the total is essentially at its lowest fraction during that point, and then it gets more expensive, largely due to oil increasing after that time. And so that has a parallel with what's going on in the model as well. And then the mutual constraint has this trend of declining for a while after an initial growth. And then again, 2002 reaching a low point in energy costs for the United States data. And this is a similar time of reaching low costs in the model, or at least before the costs start to increase. So we have this trend on the right that's similar. We have this trend in the middle that's similar, and we have this trend on the right that's similar. So this requires more, it's more investigation here. But the takeaways here in general on the model are that it's designed or strive to consistently track physical and economic flows simultaneously. So I think in some sense that's different than the solo growth model in terms of the dynamics. I think the debt is different, the tracking of debt. Explains some important coincident trends in energy and money distribution, or potentially helps explain these or provide some insights in terms of wage share, debt accumulation, and as I showed in the last set of slides, input-output structure, IO structure, or at least some measure of the internal structure of the economy from a sector-to-sector standpoint. It shows how economic decisions relate to physical resources and population. So if you can make things more efficient, energy-wise or machine-wise, you can demonstrate the feedbacks on that to future growth. And it can also help demonstrate the effects of changing the assumption about how you form prices based upon costs. And of course, it serves as a base model. Right now, it's a toy model, and the goal here is to this is kind of the base model to add other things to make the model more complicated and hopefully have more real world insights, adding other energy sources, adding other economic sectors, adding in the government, and ultimately, perhaps having this as a component to an integrated assessment model where you add a climate feedback or damages to some degree. So that's the end of the presentation there. Highlighted in this final slide is the paper, the most recent paper that I essentially discussed, which is the top one there in yellow, and then the other one below it is the previous version of the model, which didn't have the same results, and it didn't have the idea of this wage bargaining power. So this updated paper really is, I think, more enhanced. So I'll stop there, and I don't know if the person who asked about solo growth model has a further question or not, but I'll take any other questions there are. So I'm not seeing any other questions, so I don't know if I answered them. Okay, thank you for the comment of a good presentation. Thank you. Hopefully it was insightful. Again, the idea here, is, really try to employ some physical principles, at least in a very basic sense, into economic modeling in terms of, I would say that it has the basic ideas of first and second law of thermodynamics. First law being just tracking the conservation of flow of resources, essentially conservation of flow. And then the second being having an explicit parameter that is like a thermodynamic efficiency in terms of operating capital that gets dissipated, or the energy gets dissipated. All right, hopefully I didn't stump people too much, but not seeing any other further questions. And my contact information is there if anybody has any further questions they want to follow up on, obviously. Some of these principles some of these ideas in general are touched on in my book there, which is highlighted. So yeah, see a question there: to have any plan to apply it to countries with different natural endowments. I don't know if I have an immediate plan, but I would say that's a goal. One project I'm working on now, this is about studying the petrochemical sector and the decarbonization of the petrochemical sector, the potential to decarbonize it and recycle more plastics. So I'll be calibrating to the United States to do that and perhaps to a global model. And by going through that process, hopefully I'll have a process to calibrate it to other countries. But yes, right now it's just a closed economic model. There's no imports, exports. It's just a toy model that's completely a closed economy. But in general, there's, I think there's nothing in the model structure itself that wouldn't enable us to model a two economy world and with trade and interaction. So I think it's in some sense just generic, like many other growth models in that sense. It already has enough components to be fairly complex. So certainly trying to make this trade-off of adding economic sectors and trying not to add too many to where you kind of lose the insights and maybe accumulate uncertainties to where you kind of lose the big trends. But that's the task I'm involved with right now, is adding components and calibrating to the U.S. economy, again, for the purposes of studying petrochemicals. At least having a sector where we can explore that idea. Okay, yeah, I can pass back over to Rebecca if you want to take it. So, yeah.
Sure thing. IAEE wishes to thank Dr. Carrie King for an outstanding webinar. This webinar will be available on IAEE's website for future download. If you're not a member of IAEE, we encourage you to join by visiting www.iaee.org. We thank you for attending, and I officially close this webinar.